Hey, it's Cody A here. In this video, I will explain stock option in less than 10 minutes. So here's the rundown for the video. I'll first introduce what option is and introduce the two types of option, which is call and put option. Then I'll demonstrate one example for call option and one example for put option. For a new subscriber who does not know me, my name is Cody Ye. I'm a 7-figure stock and real estate investor who has been featured in TD Direct Investing and who has also been on 70+ real estate investing focused podcasts last year alone. So what is an option? Option is based on a stocks. That's what we call an underlying asset. So the option price are derived from the underlying stock price. And ultimately, people use option to have more options. Okay, not a joke, but people are using options to leverage or even diversify more in their portfolio compared to just investing in stocks. And there are two types of option. One is call option and one is a put option. And you can also buy an option and you can also sell an option. Okay, I know it's a bit confusing, but trust me, I'll briefly explain it, you'll understand fully. So really, what is the option contract? One option contract controls 100 shares of the stocks. So when you go trade an option and you see a 1.00, technically you're either paying 1.00 times by 100 or you're getting paid 1.00 times by 100. The option gives you three opportunities here. First is to buy or sell 100 shares of the stocks. Second is to buy and sell them at a predetermined price. The third is you can decide whether to buy and sell them on or before a specific date. Before I go right into an example as explaining call options and put options, buying them and selling them, I want to let you know what are the rights or the obligations for the call option and put option. So let's start with call option first. So if you're a call option buyer, you pay a fee to buy this contract. It's like you pay a fee to buy a lottery ticket. And you can buy this option contract at a specific price and within a specific time frame. And on the other hand, if you're an option seller, option writer, you're shorting an option, it's all called option seller. If you're an option seller, you collect that premium from the option buyer. And in this case, you do not have the right, but you have the obligation at that specific price and that specific time that the call option buyer agreed to. And I know that's a very mouthful, might be very confusing. So let's jump right into an example. Let's say if John is an option buyer, because John is very bullish on the Apple stocks. And John does not have enough money to buy 100 shares of Apple stocks, or maybe he just wants to use less money to control 100 shares of the Apple stocks. And John is looking for a risk-managed way to invest in Apple stocks. Now, when you try to buy something, it has to have a seller. So on the other side of the call buyer, there's the call seller, which is Steven, right? John on this side, Steven on this side. Steven already owns 100 shares of Apple. And Steven believes in that the market might be staying the same for Apple or might be going down, which means that Steven thinks the Apple's upside is very limited. So while holding the stock, Steven is trying to generate some extra income. And that's why he's selling the call option to John. So now that John is the call option buyer and Steven's the call option seller, John pays Steven, Steven gets paid, he's happy, he's more bearish on Apple or more neutral. John is more bullish on Apple, he pays Steve, they have a handshake. That's what you call an option transaction. And let's put some number into this mechanism right now. If Apple stock is a $100 and John decides to buy a $105 call options on this Apple stock for 1.20. So John pays $120 for this call option. This $120 goes to Steven. So what does John get in return? John can at any time exercise this call option to get 100 shares of Apple at $105 in return. And on the other hand, Steven receives $120 from John. Steven has the obligation to give up 100 shares of Apple he already owns at $105 at any time. And that's it, it's that simple. So if you don't understand, scroll back and listen to this one more time before we go into the put option. So now we're going to introduce the put option. In put option, again, there's a put option buyer and there's a put option seller. As always, the buyer always pays a premium and seller collects a premium. and a put option buyer has the right to sell at a specific price and a specific time. On the other hand, the option seller collects a premium from the put option buyer. Now, the put option seller has the obligation to buy at a specific price and a specific time. And let's jump right into a real example. Jenny is the option buyer. Jenny, again, is bearish on Apple stocks. Jenny does not own any Apple stocks yet, but she thinks Apple stocks will go down. So what does she do? She go and buy a put option. And Jenny is looking for a risk-managed way to profit from the decline in Apple stocks. And Ivy, on the other hand, Ivy is the put option seller. Ivy likes Apple stocks. Ivy believes that there's limited downside in the Apple stocks. Also, in the meantime, Ivy is looking at generating a stream of income while waiting to buy Apple stocks. So now Jenny, as a put option buyer, is very bearish on the Apple stock, whereas Ivy on their side think is neutral to bullish on Apple stock. Jenny pay Ivy the money, Ivy received the money, and Ivy can now potentially own Apple stocks from Jenny. So I know that might be still mouthful and confusing, so I'm gonna jump right into an example of real number. Let's say if Apple stock is still valued at $100, Ivy sold a put option contract of Apple at $95, and she got paid a premium at $1. And because we know that one option contract controls 100 shares, so Ivy got paid $1 times 100, which is $100 in return. And who's paying for that? Of course, Jenny, because Jenny is the put option buyer. And again, just like the call option, Jenny as the put option buyer has the right to exercise this contract at any time, so that Ivy has to be ready to buy 100 shares of Apple at $95 at any time. And in return, Ivy received $100 as premium, and that's the cash flow that she received waiting to own Apple at a cheaper price than $100. And this $100 is what Ivy received in return of having the obligation to buy 100 shares of Apple at $95. And there you have it. You fully understand call option, put option, and what are the rights and obligation for a call option buyer, put option buyer, call option seller, and put option seller. If you don't fully understand, rewind back and listen to this many times and you will get it eventually. Thanks for watching this video. If you want to be part of a community of more than 4,000 like-minded stock and option investor, make sure you check out the link in the description to join my Facebook group. It's fully free and you will see a lot of value-added videos.